Average 30-year fixed-rate mortgage rates have increased to an 8-month high of 7.22% on Thursday. This means that somebody looking to buy an average-priced home today will have to pay hundreds more per month compared to 12 months ago, due to the significant rate increase. Surprisingly, despite these high rates, home prices are still rising, making housing affordability the worst on record. In today's video, I will provide all the details and insights about this situation. I hope you find this value in this video. Let's get started. According to the Morris News Daily, the average rates for people with great credit have increased by 14 basis points to 7.22%, which is not far from the 12-month high of 7.37%. For jumbo loans, the rate is slightly below 7%, and for FHA and VA loans, it is also around 7%. The increase in rates by 14 basis points on Thursday can attributed to be the rise on the yield on the 10-year U.S. Treasury, which exceeded 4% due to a stronger than expected employment report released by the ADP. This report indicates that the private sector jobs increased by 497% in June, surpassing expectations of 220,000 and outperforming May's gains of 267,000. This surge in the 10-year Treasury yield, driven by a positive job market data, led to the significant increase in mortgage rates. The last time the 10-year yield was above 4% was on March 1st of this year. Comparing the current average rate of 7.22% to the rate of 5.65% 1 year ago, there has been an increase of over 1.5 percentage points in the past 12 months. These rising rates have substantial impacts on home buyers. For example, for someone buying an average-priced home with a 5% down payment, their monthly housing payment has increased from just under $2,200 a year ago to just under $2,600 today. This represents a $400 increase per month compared to 12 months ago. Moreover, due to the increase in rates by about 1.5 percentage points over the last year, home buyers will pay approximately $140,000 more in interest over the life of a 30-year loan. Affordability of housing has reached an all-time low, as reflected in the Mortgage Bankers Association's data. The average monthly housing payment, based on mortgage application payments, reached a record high of $2,165 in May. Prospective buyers are struggling with high interest rates and low housing affordability, while housing supply remains limited. However, it is expected that inventory will increase in the near future, which may provide more opportunities for home buyers. In recent trends, the MBA reports a decrease of 4.4% in applications for home loans compared to the previous week. The seasonally adjusted purchase index, which measures the number of home loans for buying houses, decreased by 5% compared to the previous week and 22% from 1 year ago. These numbers indicate that home buyers are sensitive to rate changes, and the higher rates compared to the last year continue to pose challenges for housing affordability. Furthermore, national home showings have seen a decrease, with a 3% decline compared to May of last year in most major regions. However, home showings in the South increased by 2%. More recent data for showingtime.com indicates that home showings in the first week of July decreased by 5.6% compared to this year's first week. But this is still an improvement compared to 21% decline seen in the same period last year. Given the timing of these rate increases, with a decrease in home buying activity typically observing during this time of year, it presents a challenging situation. The combination of seasonal market trends and historically high rates may result in a further decrease in the housing market's health in the second half of the year. Additionally, the increase in rates to 7.22% comes at a time when the housing market usually experiences a slowdown. Typically, there is a decrease in home buying activity and a lower number of homes listed for sale during the second half of the year. This means the timing of the rate increase particularly challenging. If rates remain at these high levels, it could have a significant impact on the housing market. Historically, over the past several years, a decrease in home buying demand during this season, coupled with rates not seen in the past 8 months, could lead to a further decline in the market compared to the usual seasonal slowdown. Furthermore, the decreased affordability caused by rising rates adds to the existing challenges faced by prospective home buyers. As interest rates and home prices continue to climb, it becomes more difficult for potential buyers to enter the market. The increased mortgage payments to income ratio, along with higher application loan amounts and reduced earnings, contributes to declining affordability conditions. To add to the complexity, the Mortgage Bankers Association reported a decline in applications for home loans, indicating that buyers are becoming more sensitive to rate changes. With rates over a percentage point higher than a year ago, housing affordability remains a significant challenge across many regions. However, there is a glimmer of hope on the horizon. The MBA experts that housing inventory will pick up in the near future, providing more options for borrowers looking to buy a house. This anticipation is based on two factors: the normal seasonality of increased housing inventory during the summer months and a decrease in demand from home buyers, resulting in longer listing times and potentially more available homes. In summary, the recent increase of mortgage rates to an 8-month high of 7.22% presents challenges for home buyers in terms of affordability and monthly housing payments. The timing of these rate increases, coupled with a typical seasonal slowdown in the housing market, raises concerns about the potential impact on the overall health of the market. However, the hope remains that increasing housing inventory will alleviate some of the pressure and provide more opportunities for those looking to buy a house. Let me know what you think in the comment section below. Like and subscribe. See you on the next one.